Hey, good evening, everyone. Marty Missouri here. It's September 3rd, 2021, Friday before the long weekend with your macro update. Going to keep this week's one quick. Our index did not move again. It's the third week in a row at 14.58. We actually had one of our inputs lose a point, another one gained a point. Therefore, they offset each other. There's a few charts that I want to show you, though. So we'll start with this week's terrible auto sales number. This is just falling off a cliff. Now, there are economists, journalists, and so forth that have a certain bent that would tell you that, oh my goodness, this really speaks to a weak or a pessimistic consumer, right? I've shown you the chart that says, I believe I have, that shows the surveys where the consumer says car buying conditions are the worst ever, like home buying conditions. It certainly doesn't mean that there aren't people looking to buy cars. It's not about lack of demand. It's about lack of the supply of things like the chips that go into the cars. Most, if not all, of the major automakers are lowering their production estimates for the coming months simply because they can't get the components that they need to build the cars. And of course, that's filtering down to the demand for used autos, which have gone through the roof. And we still see certain lots that are literally tagging on, call it a scarcity fee of several $1,000s. Not all of them, but there are still some doing that. We are seeing the price begin to roll over, which of course, as some economists say, the cure for higher prices is higher prices, because it gets to the point where the higher price itself begins to do a number on demand. And then when there's demand goes down, well, then prices come down as well. But we still have these bottlenecks that are really doing a number really across the economy. And of course, cars are still not in the least being spared just yet. Speaking of consumers and their feelings about their conditions and car sales and so forth, the Conference Board's survey came out this week, and it is rolling over as well. And I say as well because we've looked at the University of Michigan's latest survey. The weekly Langer survey used to be the Bloomberg Comfort Index. It continues to go up, so there's these real divergences between these three, particularly on the weekly index. So we've got a neutral. And when you look through the surveys, what you see is higher inflation expectations, nothing that says, we're in a recession, I'm afraid I'm going to lose my job. In fact, I'll show you some jobs data that'll confirm that. Jobless claims this week at 340 is a good number. Continuing claims continue to roll over, and you can see historically we're getting back to something closer to historic norms, and that's positive in terms of what it says about the economy. There was much ado about today's jobs number. It came in at 235,000 jobs created against 700 plus thousand that were actually anticipated. So the bears jumped all over this today and said, look, this economy is not what it seems, and so forth. That's not the right narrative just yet, notwithstanding that this setup is very artificially supported, but it is what it is. We're not looking at recessionary conditions, and missing the mark by 500,000 is huge. But when you read those surveys, I mentioned the business surveys, there is huge demand for labor out there, and I don't think it takes an expert economist to say that when these extra unemployment benefits expire and these other aid packages begin to go away, that people are going to be forced to go back to work and fill these jobs. And as you see here with average hourly earnings change, you can see that trending higher. Work weeks picked up just a little bit here. The quits rate, you can see that's been progressively rising. That's actually bullish. It's just when there's people willing to quit their job, essentially what that says is that they have something, or they believe they have something better in the offing. So quits are very bullish for the economy in terms of what it says there. 10 million job openings, of course, that's an all-time record in this country. So no, this miss in the August jobs number does not reflect a weakening environment. Labor force participation rate, dropped a lot. Of course, it's been kind of just inching back up there. It was actually off a little bit month over month. So concerning number, all the bells went off. I wrote about it this morning in terms of the market reaction and what I think should have been anticipated and what the market was actually discounting and that sort of thing. So I'll leave the jobs topic here, and you can get a little more in terms of the market reaction in this morning's morning note. The Institute for Supply Managers, Purchasing Managers indices came out this week. The services, the yellow line, that came down a little bit to 61.7, 59.9, just a slight uptick on the manufacturing. When we read through those comments, I tend to feature those on the written blog. I didn't this week. I may next week if I'm looking for some content. Same sort of thing, though. Real tight bottlenecks, tough time getting the materials, components, the inputs they need, tough labor market, want to hire people, can't find them, that sort of thing. Below 50 month over month denotes contractionary conditions. Above 50 denotes expansionary conditions. We do want to pay attention to the rate of change and the trend and the direction, but we are still solidly in expansion territory according to these all-important ISM surveys. A company called Markit, M-A-R-K-I-T, does global PMIs, records the information, releases their surveys country by country. JP Morgan puts together their global composite, so we track that. That's one of the inputs to our overall index. And you can see it continues to roll over. This was the one negative scorer in our index. As I said, the index itself broke even. But 52.5 is still expansionary, remember, above 50. But it is waning, and there was half a dozen countries in Asia, including China, that actually had below 50. A lot of it had to do with the Delta variant and concerns over that and the uncertainty as to when that's going to abate. Citigroup's Economic Surprise Index just keeps rolling over hard, minus 54. You can see it's historically low, right? Doesn't mean recession. What it means is that the data is coming in notably worse than what economists had previously forecast. So they've been missing the mark to the downside in a big way. This thing will bottom, and they'll start getting on that pessimistic side of the boat right when data begins to turn around and so forth. So, but it is something to pay attention to. It does say that the economy is not as good as what the experts thought it would be at this point. And then my last chart for you, this is actually what offset the negative global PMI print, and this is actually the S&P 500 to Treasury bond, long-term Treasury bond ratio. So when the green is going up, stocks are outperforming bonds, and I have my issues with the fact that the Fed is so intervened into the bond market, but we're still using this indicator for now as an input, and you can see that it's turned back up, and we're still kind of toppy right here, but right now is good enough to move the mark a little bit positively on our index. But just to give you how good this thing had been to us previously, right before the big decline last year, and we started hedging portfolios in the late summer of 2019, and there was lots and lots of data, but we were getting confirmation of our concerns right here. You can see that stocks were underperforming, right, defensive bonds, and so you had the stock market making new highs, and you had this diverging bearishly, right? You had that happening right before this 16% top to bottom decline. You had it before this nearly 20% top to bottom decline in 2011. The difference between these events and this event in terms of the signal is that we actually got a bottoming in the process, and this was one indicator that said we're not going to have a big bad bear market. Notice that we continued to get lower lows and lower highs, and we had a big bad bear market here. That was certainly what our indicators suggested was going to happen here, but then we got something that the world's never seen, and that's the U.S. Central Bank stepping in to securities other than what their own rules say are the only things they can buy, and that's treasuries and government-backed mortgages. Well, they stepped into all the way down to the lowest rung in credit quality corporate bonds. That has done the trick so far, right? And they'll use that trick again and again if they need to. So it kind of creates a new narrative for us that we haven't seen historically. And what it tells you is that there is virtually no place they won't go to keep asset bubbles afloat. And that is big in our long-term structural inflation narrative as well. So folks, that's it in terms of the charts that I wanted to show you today. It's obviously it's an ongoing, evolving narrative. The overall setup today is something that is very different than any of us have experienced the last few decades. There are a few worthy analogs historically. The one that makes the most sense to me, and I've expressed that here, is the 1940s analog. Last time we had over 100% debt to GDP. We had then, rebuilding from World War II. Now we've got climate change and infrastructure and this and that. So we have the need and the impulse for huge fiscal deficit spending. We have, again, a debt bubble that does not allow for a lot of monetary tightening and raising of interest rates. So we have a scenario where I think the only out for the Fed, if their goal is to keep the equity and the debt markets afloat, is to let the dollar go and to cap the yield curve. So that's inflation. And that gives us that clarity as to what to do with our core portfolio, which is something we feel very good about. But these things are going to take some time to play out. There's going to be some volatility, and we're going to continue to hedge against that really big downside risk that just is utterly there when you look at the valuations and look at how far these things have run. So it can be managed properly through diversification and critically, I think, through sophisticated hedging using options the way we are currently. Thank you, folks, as always, for watching and listening. Hope you have a wonderful 3-day weekend, and I'll talk to you again very soon. Bye-bye.